too much of a loan or too much leverage can be a bad thing. So it's, figuring out what risk you're comfortable with. You take a lot of risk and do really well, or, take a little bit of risk and not do as well.
Should I own or rent? Those were the big questions that were thrown around during the Great Recession. Now, do you think the answer would be different these days during and post-COVID pandemic? Hi, I'm Andre Chandra, founder and CEO of Propelo Media. Leaders rise up in challenging times. In today's Ask an Expert series, I'm chatting with a good friend, Alex Parker. He's the founder of LST Properties, a residential investment firm based in Louisville, Kentucky. He shares how the pandemic has largely untouched the real estate market so far, and although a slowdown may be a lagging indicator down the road, today's low interest rate environment and future inflationary pressures still makes real estate one of the best investment asset classes out there. Let's hear it from him. Well, Alex Parker, thank you for joining us. It's good to have you here.
Great to be here.
All right. Can you introduce you and your business to the show here?
Yeah. So as Andre was saying, my name is Alex Parker, and I run and founded Cap Venture Group Inc. and LST Properties, or low stress transaction properties. And what we specialize in is doing real estate investments and solutions here in Louisville, Kentucky. And we basically help sellers who are in different situations, such as pre-foreclosure or need to sell fast, or may have structural issues. So a wide variety of problems that we help them solve. And then we typically redevelop those properties and we'll resell them or put them into a long-term portfolio that we'll then hold.
Got it. Now, can you share a little bit how COVID has impacted you personally and business-wise?
Yeah. So a lot of big changes have happened the last several months, and I'm very, very thankful that luckily our industry has been deemed essential, which has allowed us to keep operating in a lot of ways like we normally would, but then also a lot of changes. So right now I'm here in my home office, which I didn't have a home office a few months ago. I just kind of try to keep the business and the home life separate. And since then I've kind of, got all set up here, and everyone in the office is kind of doing the same thing. And that's probably the biggest change is, not kind of having your pulse or, being there present with everyone else, and having to use technology such as Zoom as we're using right now to keep all of our communications and stuff going. And that's probably been the biggest challenge, is not being central like we're used to be.
Got it. Now, even though it's deemed essential, did you have to make big changes to ensure the health and safety of your team?
Yeah. So our office manager is older, and she is still at the office every single day, and kind of like, papers, documents need to be sent off, and it's kind of like a hub for everyone else. And so by keeping everyone physically separated, a lot of people aren't going to have interactions with clients, but then we have our project managers, our acquisitions managers that obviously do interact with our clients on a daily basis. So kind of having procedures for them, such as, wearing a mask for their own safety, as well as, the safety of our clients, and just trying to be responsible and moving forward.
Got it. Now, what's the biggest decision you've made since the outbreak, business-wise?
So when the outbreak first started, and just everything closed down, well, I think the biggest problem was the uncertainty in the market and what's going to happen. And I kind of felt like, we had to go one or two ways. And one way is sort of clamp down, the hatches, let's cut every cost, and, maybe even, looking at, should we lay some people off and kind of be super conservative and just try to survive this period? Or on the other hand, do we kind of double down, on what we're doing, increase our marketing expenses, and, keep operating into this kind of uncertain future? And it seemed like a big gamble at the time. And like right now, the market we're in has actually held up, pretty well. And what we decided to do was, just keep going full steam ahead. And we made a couple of changes to, say like margins of a project that we're going to take on and widening those a little bit, and then maybe not doing or focusing on bigger projects or more expensive projects that seem like it's going to be more risk, and focusing on stuff that we think would hold up best, through a down economy, and really just making that decision to keep everyone on board. And actually right now we're trying to hire on a few more people because there's a big talent pool right now that's out there that's unemployed. And so far the decision's been working out really great.
Right. Well, I like your counter-cyclical mindset there. So you
Yeah.
kind of double down and invest more. Um, got it. Now, so as we record today in late spring 2020, Fannie Mae just reported that delinquencies are up slightly. So it's just a tick up, nothing alarming yet.
Mhm.
What do you think will happen to the real estate market? Based on your experience from past recessions, or maybe your ear to the ground because you're
Yeah.
in the industry.
Yeah. So that's a big question. So I guess to break that down a little bit, with Fannie Mae saying delinquencies, a lot of people have been put on postponement like programs. So rather than paying this month, they're saying we're going to give you 2 months off of paying anything, and in that third month, a lot of times everything's due. And I can't think of the word right now. I'm thinking of.
So
You know what
some
I'm
kind
talking
of
about?
deferment.
Yeah, it's basically a payment deferment, and I think people who are on a program like that are not being counted as delinquent, and so it kind of hides the problem a little bit. And I know right now in my local market, like foreclosures and everything have been basically stopped. Evictions have been stopped, and I do think that there is going to be, obviously you look at the unemployment numbers that are out, and there are going to be a lot of people, I think, in economic hardships. And so far, those have been bridged in a lot of the ways by the government doing the economic relief plans that they've done and kind of injecting money into the economy. Well, obviously, they can't do that forever. And I think what we're going to see is eventually they are going to have to open those things up, and we're going to see a pretty big tick up in foreclosures and distressed inventory come to the market. But the good news is that right now, coming into this, we're at historically low inventory levels. So in the residential market, at least, usually a balanced market is about 6 months of inventory. Right here in Louisville right now, we're sitting at about 2 months. So it's still very much a seller's market. Like right now, we are selling most of our stuff for over asking price and having multiple offers on it. And there seems to be a lot of pent up demand in the market still that's coming out, right? So there's a lot of complicated different things going on. But with real estate in particular, we're also lucky because a big part of the stimulus for the economy is the Federal Reserve. And the Federal Reserve has basically indicated we're going to keep interest rates low. And then another big thing they've indicated is that they're going to keep the credit markets open. So in 2008, one of the big issues that we saw happen were as all these loans went bad, no lenders want to give out money, right? So you can't get a loan on a home because they're like, we have all these IOUs. They want to get some of these IOUs back before we give any more. And what we have in this market is basically the Fed signaling that, hey, we'll buy that IOU from you. We'll buy that IOU from you. And it allows the lenders to keep operating like they would without fear of them holding a bag of bad assets.
Right.
And so those two incentives right there, I think that the credit freeze up in '08 really, really, really hurt the economy. And I don't think we're going to have that issue. And I think the Federal Reserve signaling low interest rates, well, right now, it really is a great time to buy a house if you can afford to, because you can get a historically low rate on that home. So you can get a lot more house, with the same purchase price, or pay a lot less over time with the same purchase price with that lower interest rate. And so I think these lower interest rates right now is bringing out that demand. The question is how much of that demand is pent up and out there, and how long will that last? And then, how much supply will come in there. But my general theory, and again, no one has the crystal ball to look and see what's going to happen in the future. But my general theory is that, which was true in 2008 as well, is that your medium and below priced homes will generally stay pretty stable. And really what you'll see, I think, in the months coming ahead is going to be the higher priced homes are going to take a bit more of a dip. And then in really highly appreciating markets. So I'm in Louisville, Kentucky. So I think like a market like ours, where our average sales price is, around $200,000. We have other markets that are much, much higher than that. And in a lot of these markets, when it's going up, it's going up like this, and we're kind of going up like this. And when the market falls in like some parts of California, it'll come up and it'll, come sharply down and then come back up. And where markets that don't have real fast appreciation, it's kind of like that. But in general, still lower priced houses in those areas, I think will be safe as long as we can get the economy opening back up in the near future. And it looks like we're already seeing signals of that, which is really good. And I know it's not in all parts of the country, but several parts of the country, have the plans to get the businesses back open, and a lot of them already are back open.
Right. Yeah. So your point on the government ensuring liquidity is very important. It's one of the biggest differences between now and what happened in 2009. And like you said, I think it comes down to really, having a job. If you're employed, you can really take advantage of the low interest rate environment these days. But at the same time, there's going to be these opposing forces from people who lost their jobs and now they suddenly can't pay. Now, speaking of deferment, maybe you can elaborate that a little bit more, because if they do get deferment, cash flow wise, it would be very difficult to pay back, 2 or 3 months worth of deferment all on the fourth month or the fifth month. That's a huge commitment. Do they have more of a runway? What's the deferment program looking like these days?
So the deferment program, a lot of people are getting set up, I think, a net 3-month deferment program, and it's going to be a big issue. At the same time, there is a lot of creative ways that lenders will work with their clients. And probably the best thing, for someone in that situation is to try to work out a plan where they're going to extend the loan and just put this balance on the back end of it. Okay. And I have a feeling that in order to prevent the inflow of foreclosures they are going to have, you're going to see a lot of lenders doing workouts like that. So the lenders don't like, it's really bad on their balance sheets to have stuff that's getting foreclosed on. And they have like certain ratios and regulations they have to meet. And what you saw after 2008 is a big decline in foreclosures, but also a big uptick in doing some of these creative deals. I'm trying to think of the name of the one that I'm thinking of right now, but basically it's adding on a greater balance for them and kind of postponing it. And so I think you're going to see a lot more of that, but I think you're also going to still see a big uptick in the foreclosures. And then the big question is for landlords as well, which we're lucky to be getting almost all of our rents right now. I know a lot of people are not like that. And we're also in residential, right? So residential, single family is one of the safest asset classes. When we look at retail and office spaces, I think we're going to see some really big issues there. Like I was reading an article yesterday, like one of the largest retailers in the United States for retail space is only getting like 20 or 30% of their rents in right now. And looking at the loans that investors have that own these assets, it's very, very thin margins as it is operating at, full capacity. And so having that, cut somewhere in half or anything close to that, they're not going to be able to afford their debt service. And so I think we're going to see some really big issues there, but also, maybe opportunities for people looking to pick up those asset classes at a cheaper price.
Got it. Yeah. I totally agree with you that the bigger issue will be in the commercial side.
Yeah.
because on the residential side, everyone still needs roof over their heads, and a lot of landlords are working with the renters
Yeah,
right now, and they completely understand deferment, and at the same time they need to be able to pay that back later, maybe on a longer ramp, so maybe they have 6 months, 12 months to kind of make up the unpaid rents, because it's still necessary. But on the commercial side, yeah, I see a lot of businesses are just moving online, and retail's been in trouble even before COVID, but
yeah,
maybe this is the one that kind of pushed this further.
yeah,
So it's some concern over there. Yeah. Now, post COVID, in terms of comeback strategies, especially in your industry, in the real estate market, or in kind of fixer upper, buying and selling of homes. What signals are you looking for, and what will you plan to do first?
yeah. And so I think, post COVID, it's like trying to figure out when when that time will be. And so like right now in the residential, we really have not felt the effects of it too much, except we help out a lot of people in a pre-foreclosure situation, trying to figuring out what your best, solution is. Well, that market kind of for us has, we're talking to a lot of different clients, but really everyone wants to wait and see what's going to happen, what the government's going to do. And so from an acquisition standpoint, it's slowed down a bit, and we've kind of, switched over, and now we're marketing to more landlords, who might not be getting rent. And in order to fill up that supply of properties, we need to be coming in every single month. And so that's been a challenge working right now. So post COVID, I think we're going to have a lot more foreclosures that has kind of been pent up, during this time. And so we'll probably have a lot going on there, where we can help those sellers out. And then I feel like the economy, as I was saying before, hasn't really felt the shock that it's going to feel because of the government intervention. And so I think we actually are expecting prices to, fall a little bit, and trying to be a little bit more conservative, but that might not come until 6 months, from the day, even though it looks like the economies are starting to open back up.
Right.
So we're trying to be safe in our margins by making them just a little bit bigger, than what we normally would because of the unforeseen. And but at the same time, we're spending more on marketing, costs to acquire these properties. So we're going to have more deals coming in to select through to pick what the best ones are, and then trying to build, our talent as well. Like I was saying before, so many people are laid off right now, so trying to get some talent, new talent in that otherwise would be, employed because they're not looking for another job. They're, happily employed in their current role. And but coming out, it's kind of just to keep that, same strategy. And as the uncertainty disappears, or we know, hey, we've hit, the rock bottom, we'll actually be, probably looking a little bit more into those retail assets, like strip centers and stuff like that as well, and some of those larger commercial deals, because we think they're going to be at a great discount to purchase on the market. So kind of diversifying out of just single families, and keep doing what we are in the single family, basically.
Got it. Got it.
Yeah.
Now, for an investor who's looking to diversify their investments, what do you think of real estate? Is it a good asset class to invest in right now?
Yeah. So that's also a loaded question. So real estate, like we've kind of already discussed, is you have large REITs or real estate investment trust that you can buy into almost like a stock, on your online brokerage dashboard, that are kind of, buying up hundreds of millions of dollars of assets like all the time. And they're bigger. You have, more local operators like us that kind of have a specific niche in what we're investing in. And then you also have in real estate investments a level of how passive it's going to be, right? So do you want to, put your money into a real estate investment trust that's, diversified for you and get a check every month?
Right.
or do you want to go buy your own single family rental and manage it yourself and collect the rent and kind of you might even fix it up a little bit yourself. So it's a really big realm. And I think I think one, it is a very good asset class, but you want to be careful about a few things. And you want to decide for yourself, how passive do I want to be, or how much work do I want to put in it? And generally, the more work that you put into it, the bigger return you're going to get. And I think the single family rentals right now is, for someone to own, is still a great investment, because with the leverage you can get with a mortgage, you can easily achieve 12 to 25% returns. And it's like almost like anything out there, like a stock market, something to get a consistent return like that's really tough. And I think you also get really good returns dealing with like boutique firms that kind of have a special niche. And like right now, just to diversify, I do invest in some different real estate firms other than just our own. And if someone has a niche, a lot of times they're able to get assets that are underpriced, where in the stock market, there's always the supply and demand. Well, in assets, or real estate, you can often find people all the time are actually getting deals that are below what the market value would be. And so there's
Right.
opportunities there as well. And then keeping your eyes open for opportunities like we were just talking about, retail, shopping centers, and other commercial assets. Office space are probably not right now at this minute, but are going to be going for very big discounts here in the near future. So jumping into those as well. So I would say one, if you want to be completely hands-on, doing rentals still is very good. Having a firm that kind of has a focus is really good. And then the REITs that are, very large, those can be good investments. If everything's going up, everything's going up. But at the same time, you have money managers in these that, have to get out so many $100 million in a certain time period. And it's like they're buying up what assets they can. And all these different managers are competing for the same assets, right? And that's one of the reasons I think we're going to see a really big issue, is that these big assets with institutional investors, well, they're all being bought at these really high prices. And now it's dropped down, what's going to happen. So I think to kind of zero in on your question, yes, it's a good investment. I think you're going to get better returns, though, focusing on a more local or niche driven provider. And if you don't mind, getting your hands dirty, or, want to do single family rentals, or even, a strip center rental yourself, you can definitely get better deals if you go out there and find it. But of course, that requires the experience and like the education and everything to do that. You don't want to go out there and just go, buy something
Right.
and not know what you're doing. Yeah.
Yeah. Yeah. No, people say that the stock market is a close to perfect market because the speed of trading and everything, everything is more or less pricely fair. But the real estate market, you can, if you do your legwork, you can spot some undervalued properties, some undervalued assets there that you can buy at a discount and then, sell at a profit.
Absolutely.
Yeah, and the second big thing about real estate is that it's a leverage investment as well, right? So your cash on cash return is always greater than just straight up investment into stocks and bonds.
Yeah, 100%. And a lot of, times when I'm talking with like a new investor and kind of explaining it, it's like, you're paying this interest rate on it. Well, anything that you're getting return wise over that's like a spread you're making on 80% of that deal, or whatever your loan to value is. But obviously, as we're going to see in this crisis, too much of a loan or too much leverage can be a bad thing. So it's, figuring out what risk you're comfortable with, because you take a lot of risk and do really well, or, take a little bit of risk and not do as well, but finding that comfort level, because we will see, I think, in the coming months, a lot of people that were a little too leveraged in certain asset classes get in big trouble. And what you were talking with leverage too, I also think real estate's an excellent investment, because in the past several months, we put trillions and trillions of dollars on our debt. Like, so our national debt level was already very high. Um, and there's only, there's a few ways to get that down. And you look at what economists and different people are saying is, I don't want to say the wrong percent, but well over 100% of what GDP is right now in our holdings. And in order to pay that down, we're gonna have to either print money to do that, or raise taxes. And generally, what you see is in the past when other economies have done this is it's going to trigger a higher inflation rate, right? Than what we're used to seeing. And the past several years, oddly enough, we've had very, very low inflation. And it's like we've had everything in the formula for inflation except wage growth.
Mhm.
And I think coming out of this in the next several years, no one really knows how much, but I think we're going to see higher than normal inflation. And in which case, real estate's a great investment asset class, especially if you're leveraged. Because say if you buy in on a $100,000 house, you have a $80,000 loan, right? So you only have $20,000 into it. Well, real estate historically has risen very well with inflation. So, we have 3-5%, maybe like 1 year, 7% inflation or something like that. That compounded over time, you're going to get your asset to hold that value, and you're leveraged on it. So your returns become exponential.
Right, right.
Yeah.
Yeah, yeah. So when inflation happens, real estate just tracks real well with that rate of inflation.
Yeah.
Um, During those environments, the worst thing you could be holding on to is cash, right? Because
Yeah.
it decreases in value.
Yeah. So if you already have that deal in your portfolio, well, your loan payment stays the same, but your rents go up and the value goes up, which ultimately, increases the asset value for you and limits your risk.
Right, right.
Yeah.
All right. Well, Alex, is there anything that I haven't asked you that you'd like to share?
Um, so we've talked a little bit about real estate as an asset class, what's going forward. Um,
If no, that's okay. We could just
yeah.
cut that part out.
Yeah.
Yeah.
Cut,
So
cut that part out if you can.
I know I like to ask that.
Yeah.
All right. So let me just conclude. So, well, Alex, thank you. This has been really enlightening. It's great to hear that real estate is still pretty strong and healthy. We just need to kind of watch out a little bit for what's going to happen 6 months down the road. But it sounds like this industry is one of the lagging indicator industries. Some of them are super early, like hotel and airlines.
Yeah.
Yours sound like it's more of a lagging indicator. I just want to wish you the best. I really believe that there's light at the end of this tunnel. So just want to wish you the good luck and all the best in your endeavors.
Hey, you as well, Andre. Great talking with you.
All right. Thank you.
All right.